Okay, let's wrap this up in the back part of your packet here. On the left, we're going to have sort of the steps and the logic behind loose or easy money policy. And on the right, we're going to have the steps or the logic behind tight monetary policy. Okay, here we go, starting it off. So if the Federal Reserve wishes to expand the economy, they see a recession, they see an economy, economic conditions that are poor, what can they do? What should they do? Well, they should work to increase the money supply. To do this, they should buy bonds from the banks. As they buy bonds from the banks, this will ultimately increase the money supply. And by increasing the money supply, what the Federal Reserve is hoping to do is to drive down interest rates. And as they drive down interest rates or they lower interest rates, this becomes good for borrowing. Low interest rates, again, make access to credit easy. And so what the Federal Reserve is trying to do here is they're trying to get consumers and businesses to borrow. By driving down interest rates, they will stimulate interest-sensitive spending. All of this borrowing by consumers and businesses will lead to increased spending. If people borrow to buy homes, if firms borrow to expand their business, this will lead to increased spending. It raises GDP, and as companies sell more products, they are more willing to employ people. Those employed people will have more money to spend, and the more money is spent, the higher GDP rises, and again, this cycle sort of continues on. So what should the Federal Reserve do again to expand the economy? They should take these steps. Buy bonds, this increases the money supply, it lowers interest rates. Consumers and firms respond by borrowing more money, and by borrowing more money, this leads to increased spending. This increased spending leads to increases in our GDP, and that leads to full employment. All right, so let's imagine that the economy is expanding, that it's inflationary, and that the Federal Reserve wants to slow it down. They want to slow down and contract the economy. What should they do? Well, it turns out it's almost the exact opposite that you see on this left column. Instead of buying bonds, they should sell them. And when they sell bonds, it's going to decrease the money supply. It's going to take money out of circulation. When money comes out of circulation, this will effectively raise interest rates because the banks, again, will have less money in their pockets, so to speak. As interest rates rise, consumers and firms will borrow less, and this will stimulate saving. As more and more people save and less people borrow, spending will fall. And as spending falls, again, this is a contractionary measure, so we'll see GDP fall. As GDP falls, the economy will slow, and this will lead to a slowdown. So again, over here on the left, we have loose monetary policy or easy monetary policy. On the right, we have tight monetary policy or contractionary monetary policy. Okay, so we have one more flowchart we're going to fill out, and this is going to kind of bring together the Federal Reserve and its tools for monetary policy. Okay, the Federal Reserve's nickname is the Fed. And we know the Fed is broken into two parts. It has a board of governors. There are 7 board of governors that reside in Washington, D.C., and the 12 district banks that exist throughout the country. They meet 8 times a year in Washington, D.C. as a part of what's called the Federal Open Market Committee. And this Federal Open Market Committee comes together to discuss monetary policy. Now, monetary policy is largely things of money, or the financial and banking sectors in the economy, but it extends to the health of the economy. And the Federal Reserve has a dual mandate, keeping prices stable and having full employment. The Federal Reserve has 3 tools at their disposal. Number 1, open market operations. Number 2, the required reserve ratio. And number 3, interest rates, specifically the discount rate and the federal funds rate. Now, what do open market operations refer to? Well, they refer to the buying and selling of bonds on the open market and essentially either increasing or decreasing the money supply through the buying and selling of securities. The required reserve ratio represents the percentage that banks must hold in reserves on every M1 money deposit. And interest rates represent the amount that the banks must pay back to the Fed as a lender of last resort, or the amount they must pay to member banks when they borrow from each other. Okay, so if the Federal Reserve wants to increase the money supply, they should buy bonds. That'll take bonds out of the banking system and increase the reserves of the banks. If they want to decrease the money supply, they should sell bonds. That will increase the bonds held by the banks and decrease the money supply. If the Federal Reserve wants to increase the money supply, they should lower the required reserve ratio. If they lower the required reserve ratio, that means that they're going to increase the amount of money that banks can lend. That'll lead to a greater multiplier and ultimately an increase in the money supply. If they wish to decrease the money supply, they should do the exact opposite. They should increase the required reserve ratio. If they increase the required reserve ratio, that will decrease the amount that banks can lend and then ultimately lead to lower increases in the money supply. So finally, the Federal Reserve controls interest rates. If they wish to slow down the economy and slow down the rate at which money can be borrowed, they can simply raise interest rates. If they want to increase the money supply and increase the amount of money borrowed on the market, they can decrease interest rates. So this is a flowchart that represents the Fed, its tools of monetary policy, and the impact they can have to either increase or decrease the growth of the economy through expansionary or contractionary monetary policy.